In this presentation, we will enter an adjusting entry related to retained earnings in our second year of operations using our worksheet for that second year. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We are in Excel. We're currently at 150%. We're in a worksheet with two tabs. We have our tab for year one, where we have entered data, and then we have our tab for year two, where we have taken the trial balance for the second year of operations and put it into our Excel worksheet. Now that we're in the second year, we want to take a look at a common problem that we will have, and that is that does retained earnings reconcile? That's the first thing we really want to look at with these worksheets. And that's why it's nice to use the same worksheet, because then we can go back to it, compare it to the prior year, and take a look at that first thing that can cause problems. Why wouldn't retained earnings tie out? Well, many times it could be that the client didn't put our journal entries into QuickBooks. So if our journal entries didn't go into QuickBooks, then retained earnings wouldn't tie out. And if anything was adjusted in the prior year, such as checks being deleted or voided, then retained earnings might not tie out. We can go back and try to figure those things out by entering our adjusting entries and figuring it out in that way to see what that difference exactly is. Or we can just say, okay, retained earnings doesn't tie out. We're just going to make a journal entry to make it work. And that's what we'll do here. We're going to try to make a journal entry to make it work. So here, for example, is the year two. Here's our problem. We have the year one. I'm back to year one now. This is the book trial balance in the middle, the book trial balance that we have adjusted for as of this point in time. So we're going to say for now, this is our ending trial balance for year one, and just give a comparison of retained earnings, if that's the case, to the retained earnings in the following year. So we know that the income statement will close out to retained earnings. So therefore, if I highlight all this stuff from the equity on down, here's equity, here's income, here's expenses. If we were to add all that up, it adds up to 174,773. That ending balance should be the beginning balance for year two. So if I go over here to year two, that should be the beginning balance here, or at least the sum of these two, and it's not. So that's going to be our question then. What are we going to do? This should match out, or else we're not going to be able to roll forward from year to year correctly. So we got to figure out how to tie that out. One way we could do that is just do a comparison from what we have in the prior year as of the end of the year and what is in QuickBooks as of the end of the year. So if we have the QuickBooks file, we can take a look at this. So what we'll do is we'll then go back into QuickBooks, and let's take a look at the report. We're going to go to Reports up top. Let's go to Accounting and Taxes and take a look at the trial balance. Now we want to see the trial balance as of the end of the prior year. So we're currently looking at 2020. We want to see the end of the prior year to see what is different from their prior year to what we had entered in the prior year. So we're going to enter the dates then 01/01/19 to 12/31/19. So this is the prior year that we had entered. So if we go back to our worksheet then, remember we're in year one was 2019. We're currently saying we're now in year two that we have just entered. What we want to do is take a look at, okay, and go back to year one and try to compare. This is where we ended at. This is where the books should be at in QuickBooks if they had entered all of our adjusting entries and hadn't deleted or done anything funny in the prior year. So if they just didn't enter our entries and didn't enter anything in the prior year, then this is where they would be at, and we would have to basically make an adjustment for our adjusting entries. But if they didn't enter our adjusting entries, or entered them wrong, or if they deleted something or both, then they may not even be here. So what we want to do is take whatever numbers are there in QuickBooks, and this is going to be a year later. So a year later within QuickBooks, we ran the prior year report to see what is currently in there, and then compare it to what it should have been, what we adjusted it to be, which is going to be this column. We're going to compare it to the book's trial balance. So that's what we'll do now. So to do that, we'll make a little worksheet. So I'm going to copy this cell, this sheet, in trial balance year 1 by holding down Control and then left click and dragging it all to the right, all the way to the right. Double clicking on it, I'm going to call it retained earnings. So this is going to be our retained earnings journal entry. And then what we want is just really this column. All we want is the adjusting column. Now there's currently a formula in it. So I can't just delete these two columns or the formula will go away. What we'll do first is highlight the entire thing. So we're going to highlight the whole thing or select it down to here, right click and copy. And then we'll paste it just the numbers, pasting it 1, 2, 3, just the values, I should say. And there we go. So now there's no formulas in it. So if we delete these cells now, we're not going to lose anything. Or you could just hide these cells if you wanted to do that. So we can now highlight these two cells, right click, or the whole columns, right click on the selected columns and delete them. And I'm going to do the same over here. I'm going to select O and P columns, let go, right click the selected area and delete them. We'll label this the adjusted trial balance as of 12/31/19. And then we want to take the same information from QuickBooks. So here's the trial balance from QuickBooks as of the same date, the end of the prior year, not the end of the current year that we are working on. And we'll do the comparison to see what the differences are. The easiest way to do this would just be to export this by going to Excel and create a worksheet. I'll typically make a new worksheet rather than putting it into the one we are working in. So we'll create a new worksheet with the trial balance, which will look like this. And then we could just adjust this to make our comparison. So I'm just going to take this Excel worksheet and make some adjustments to it. So we'll put it into our formatting I'll make this a little bit larger. Let's go to View and Windows and remove the split. Let's make it larger at 150. We're going to go down and flip the sign, converting this into our plus and minus format for debits and credits. So I'm just going to copy this down. Going to select the whole worksheet by hitting the triangle, right click on it, format the cells. Then we're going to go to currency. I'm going to make the negative numbers and we'll keep the decimals for that now. No $, and OK. So there we have that. And now I'm just going to say negative of this number. We'll copy that down using the autofill. Scrolling down, we're going to do the same thing here in C32, negative of this number. And then negative of this number. Just taking those numbers and flipping the sign is all we're doing there. Now I'm just going to copy and paste the same information. So I'm going to highlight all these cells, right click on it, copy it, and then paste it in the same area, 1, 2, 3, without the formulas. So there we have it. And so there's no formulas up top. So now we could just delete these cells. So from D to E, I'm going to select those, right click, and delete. Now what we really want is just the balance sheet, and all the other stuff is going to roll into equity. So in other words, we want to have everything down to here, and then everything else is going to close out. So the way we could do that is just basically select all these cells and say we need 203, 705, 92 to balance. Or in other words, we could just delete it and put in what we need to balance, which is I'm actually going to highlight all these cells and delete all income statement accounts. And then right click and delete. So all income statement accounts are gone. Now we need this amount to be in balance. So that's what I'll put into equity. 207, 203, 203, 705.92. So this is basically our post-closing trial balance, we can think about it as. And if we go back to QuickBooks and we go to the balance sheet just to check this to see what we're doing, to go to the reports, company and financial, and go to the balance sheet. And if we made this balance sheet as of 01/01/20, the first day after the prior year, and if there were no other transactions, then our equity section should be that 203, 705, 92. So if we go back to our worksheet, 203,705.92. So everything else rolled into equity. And so that's where we are as of the end of the last time period. We're gonna take this now. I'm just gonna copy these numbers. We'll select these, right click and copy. Gonna take them back over to our worksheet here and put them, right click and paste. Let's go with the destination. Let's paste them 1, 2, 3. So there's our pasting. Now we just got to make sure to go back through them and line them up to make sure that we have the correct accounts lined up. So I'm going to make this go to one side, and then we'll go back to our prior worksheet and we'll pull this to the other side. So they're side by side. We could see that we're at least one account off because it should be, this number should be down below. So if we go side by side, we could say, okay, the checking account, it looks good, accounts receivable, inventory, prepaid insurance, short-term, undeposited funds, furniture and fixtures, accounts payable, the Visa should be 1.6. So we missed one up here somewhere. So we got accounts receivable, inventory, prepaid insurance, short-term investments is 0, undeposited funds, furniture and fixture. The accumulated depreciation is what we're missing. So what we'll do is just pull this down. Accumulated depreciation, we'll select those cells and just pull it down one. And I think the rest of them line up for us here. So then we've got accounts payable, Visa, payroll, sales, loan, opening balance, equity. So now they all line up, and we could just look at the difference now and say, okay, well, this is where we are in trial balance. So I could say QuickBooks trial balance as of the same date. I'll highlight this, paintbrush it, and paint it here. And this is where we're at now. So now we just need to look at what the differences are, and that's the adjustment we need to make. That's the journal entry we need to put in place in order to be in balance. So what we'll do is take a look at this first adjustment we have here. This is the first difference that we're going to see in prepaid insurance. And this is where we need to be. This is the trial balance, and this is the QuickBooks trial balance. This is where the books are currently at. So we need to credit where the books are currently at to get here. So I'm going to do a formula, a difference formula, which will be equal to this cell minus this cell. So column M, N, minus column O will give us that difference. And now we can copy this all the way up and all the way down. There's only zeros up above it because there is no difference. And we copy it all the way down. And I'm going to copy it actually just down to the equity. So that's going to give us our difference. This bottom portion, we need to get rid of that just as we did with our other worksheet. We're going to delete all of the income statement accounts. I'm going to select the cell 21 for merchandise and go all the way down to cell 47 or row 47, right click on them and delete them. And then I'm just going to change this equity. I'm going to delete it. And then see, that's what we need to be in balance, negative 177,173. In other words, that's equity after the income statement temporary accounts are rolled into it. And so this cell has no meaning now. So now all we need to do is enter this journal entry. This is the retained earnings we should be at after, according to our adjusted trial balance, and this is the retained earnings that the books are currently in QuickBooks. So to do that adjustment, we need a 26,533 adjustment. The other accounts we need to adjust will be these. So we're just going to go straight through and enter this adjustment now. So we'll go to prepaid insurance. So I'm going to copy that. We'll go back to the trial balance. To enter this, I'm going to go back to the year 2 trial balance. That's what we're working on. We're going to delete all the information that's currently in here. So I'm going to delete this. We can keep the 1. Delete this and delete that, and then I'm going to hide these cells going from F all the way to K. Let go, right click and hide. Okay, and then we can right click and it's gone. We can do it this way too. Let's go to C5, just equals, back to retained earnings, pick up the prepaid insurance, tab, credit side equals, back to retained earnings, picking up that difference column, and enter. Next one equals furniture and fixture, back to retained earnings, furniture and equipment, and that's going to be a debit, I believe. So equals, actually, is it a debit? Let's go back over here. The furniture and equipment is a credit. So we'll be in the credit side equals, back to furniture and equipment. We're going to credit the 20 and enter. Then we have the accumulated depreciation. Before I do that, I'm going to format all these cells to not have indentation by selecting the first one, Home tab, Paintbrush, and then highlighting the rest of them. Okay, so next one we're going to say equals, go back to retained earnings, and we want the depreciation, enter. Then we need a credit. So we're going to say equals, back to retained earnings, the 7,000, and enter. Next one equals, we'll go back to retained earnings, and we'll pick up the draws, which are owner's draws. Equals, go back to retained earnings, owner's draws. And now the draws could have been something that's current or non-current, so we might have to take a look at that, but we're going to go back to, it's going to be a debit, so equals the retained earnings and this one, and then the equity equals back to retained earnings, the equity, and it's a debit, so equals back to retained earnings. We'll pick up the 26,533 and enter. So that's going to be our adjustment. And again, we need to look into draws and see how much of those draws were in the current year versus the prior year. But that's going to be one way that we can start to at least quickly put together some adjustments and make the retained earnings roll over from year to year without basically entering in all of our prior adjustments in order to get to that point. So if we see it, then of course our debits equal our credits right here, and we can post this out. If we post this out, we'd have to go to prepaid insurance. So scroll down to prepaid insurance equals that 1833. Furniture and fixture is going to equal the, I'm sorry, that's not furniture and fixture, the one above it, equals the 20,000. Accumulated depreciation equals the 7,000. And then we'd have to go to the owner's draws equals the 2,300. And this owner's equity equals the 26,533. And that'll pick up our equity number. Again, we gotta take a look at draws more carefully and just make sure that we'll take a look at what current draws are and the prior year draws are. But you can see how that'll give us at least a pretty good start in terms of how can we think about getting the retained earnings to tie out without basically entering all of our prior journal entries or trying to figure out exactly which check was deleted or something like that from the client. If we just need to get to a starting point and we don't know exactly what they did, then we could take a look at that. Note that if you do have some adjustments or changes in like the checking account, that's something you're going to want to be careful of to make an adjustment to in this journal entry because it's already been reconciled. So you may not, if there's an adjustment to the checking account, you may want to say, I'm not going to make an adjustment to the checking account, or something like retained earnings, also an account you want to be careful of because that's going to affect a customer account. And so you may not, if there's something different in retained in accounts receivable, you may say, either that's significant and I need to look into it, or maybe it's insignificant and I can make the adjustment somewhere else to be in balance for it, given that fact, given that the checking account's already been reconciled and I don't want to enter anything into it that would throw off the checking account or retained earnings. So again, just an example of what commonly happens or oftentimes is a problem when you first start off with a worksheet in the second year of operations if you're rolling over the retained earnings. Also note that after entering this adjusting journal entry, we would expect at the end of the year, this being the second year, 2020, the current year we're working on, that this number, the 192,692 would match, if we go back to our retained earnings, what we calculated for our equity section for the adjusted trial balance. That's what we were adjusting to after all with the 26. Why isn't it there as of the end of the year? It must be that something got posted to it. So I'm going to go back to the trial balance. So something has been posted here. So now you want to go back into QuickBooks and say, okay, did someone post something directly to the equity section, possibly a draws or an investment? So then we could go back to our QuickBooks, and as of January of the current year, the first day of the current year, we have what we would expect, what we had in our worksheet, the 203,705. If we go back to our worksheet then and go back to retained earnings, we had the 203,705 rounding 706. And then we adjusted with this 26,000 to the 177. But if we go back to QuickBooks and look at the end of the year, if I double click on this, for example, to see the detail of it, and we change the end date to be 12/31/20, the end of the year, we see that we have these two transactions that were posted to it during the year of 2020. So now we're going to have to go back into those transactions and say, what were those consisting of? And possibly, because normally not too many things are posted to retained earnings or to equity. So therefore, these could be investments or draws, and we have to determine what those are and if we need to make any adjustments for them. For more accounting information and accounting courses, visit our website at accountinginstruction.info.